All right, now we are going to revise the IAS 19, which is employee benefits. And again, as the name suggests, that we are supposed to discuss the accounting treatment of the employee benefits, the benefits that are being offered to the employees. Eventually, it's an expense of the company. But not all of the expenses are being paid immediately. Some of them are being paid in the future. Some of them are being accumulated. So there are many aspects of these employee benefits. So when you talk about the IAS 19, actually they talk about the 4 types of the employee benefits. They have split those benefits into 4 types. The first one is the short-term benefit. And these short-term benefits are related to the salaries, the bonuses, the benefits, the salary, which is the minimum guaranteed portion being given to the employees. The bonuses are usually the performance-related elements. And again, that belongs to the 12 months. The bonus of the current year, the bonus of 2021, the bonus of 2020. So the short-term benefits, and similarly, the other benefits such as the cars and the house, or the, for example, gym membership, or sometimes the annual subscriptions and things like that. So all of them are related to the 12-month span, and that is why we call that thing as the short-term benefits. So that is related to the 12-month span. And then we have the long-term benefits. Now, long-term benefits, as the name suggests, are the more than 12 months benefit, for example, long leaves. And then we have the post-employment benefits, which is the main concept, main concern of the IAS 19. Post-employment benefits, which includes the pensions, like the one of the main topic of the IAS 19, which we are supposed to discuss, the post-employment benefits. And then we have the termination benefits. So anyways, the main concern over here, because it's a revision of IAS 19, is the post-employment benefit, in which we are supposed to discuss the pension, accounting for the pension. Now, when you talk about the post-employment benefit, we have 2 things in it. We have the defined contribution and the defined benefit. These are the main things within IAS 19, nothing else. And the question always tests these 2 concepts, defined contribution and the defined benefit. Now, when you talk about the defined contribution, as the name suggests, this is the contribution being made by the employer and the employee towards the pension plan. Contribution of the employer and the employee towards the pension plan. Now, this sort of arrangement is usually common within the private sector. And the defined contribution is that the contribution is defined in the remuneration policy. Let's assume 1 day salary, 1 day salary. So for example, the salary is $3,000. Let's assume $3,000, for example, is the monthly salary. The policy is that the 1 day salary will be deducted. Now, 1 day salary is going to be $100. The $100 will be deducted from the employee, and the similar contribution deducted from employee, and the similar contribution is being made by the employer. Contribution by employer. Now, we are not talking about the deduction from the employee. This is not our concern. We are being concerned that how this contribution made by the employer in the employee's pension plan should be accounted for. Now, remember one thing, that in the defined contribution, only the contribution is defined. Only the contribution is defined. And the employer has no other responsibility in relation to the plan, such as guaranteeing any amounts to be paid by the end of some certain number of years. No, the employer will be making the contribution into the employee's plan, and whatever sum it is going to made belongs to the employee. Employer is not going to guarantee any amounts in the defined contribution scheme. So only the contribution is defined. That contribution by employer, that contribution by employer is recorded as an expense. That contribution made by the employer is recorded as an expense. Now, how to write the journal entries of it? So because it's an expense, so debit profit or loss, because it's an expense. Whenever we are recording an expense of the loss, we just debit profit or loss. We just write debit profit or loss, which represents the expense, and credit is contribution payable. Contribution payable. Because first of all, the contribution is due, it becomes your liability, and when you pay that contribution, that liability is de-recognized, debit contribution payable, and credit cash. So remember, when you talk about this, the first entry, this is the expense and the accrual being made. Accrual means the expense that belongs to the current year but not being paid by the year end. And when it is being paid, the accrued liability is de-recognized. The liability is de-recognized. Sometimes it is possible that you are paying the contribution in advance. Sometimes the contributions are made in advance. For example, for the full quarter. In that case, you should record a prepayment. Record a prepayment as a current asset. In that case, record a prepayment as a current asset, and the double entry would be debit contributions made in advance, because this is the current asset, and credit cash. So this is the double entry when you have made the contributions in advance. So remember one thing, sorry, in the defined contribution, the employer has no responsibility other than the contribution which is being made to the employee's plan, that is recorded as an expense, and no guarantee is given for a particular sum to be paid by the end of the employment. All right, now we are going to discuss the accounting for the defined benefit, which is again very important for the exam. Now, as the name suggests, that the benefit is defined by the employer, which is going to be given to the employee. Benefit is defined. Now here the employer will be having two responsibilities. Here the employer will be having two responsibilities. The one is the regular contributions being made into the employee pension plan. And the second thing is going to be any shortfall. Now, I'm not going into detail why we'll be having the shortfall. Just understanding this thing at the moment is uh, because these are the actuarial assumptions. Like whenever you want to make a certain amount by the end of the 20 years, you're going to take the assessment of the actuary who is going to tell you that, for example, if you want to make a certain amount through compounding, through investments, if you want to make a certain amount, let's assume after 20 years. So today you have to put this much amount into the pension plan. And now when this amount is being compounded and the investments are being made, the returns are being added every year, you're going to reach the certain amount. But sometimes there are changes within the interest rates, returns. In that case, there is usually a shortfall. So if there, for example, is any shortfall, the employer needs to make sure that shortfall is being fixed. So there are two responsibilities. First of all, the regular contribution, and the second thing is regarding any shortfall. Now, in order to understand the accounting treatment of this, you need to know how many figures we will be getting for the financial statements. So we have three types of figures which we'll be getting for the set of the financial statement. The first thing is for the statement of profit or loss, or you can say we have the element for the profit or loss. Then we have the element for the other comprehensive income. And then we have the element for the statement of financial position. So when we talk about the profit or loss thing, there will be the service cost, which is a very important component. Service cost, this includes current service cost, every time the employee has served you, there is a liability in you. Like, for example, if they have served you in the year one, now this is actually a liability in you. Now they have served you in the year two, this is again a liability on you. Every time they're serving you, this increases your liability regarding the pension. Because every time they're serving you, every year they are serving you, this increases their right to get the pension. And when they are getting the right to get the pension every year, for you, it is going to be a liability because they have provided you the service. Now it's your obligation to pay them the pension for that year. So the service cost is either related to the current service cost. This is current service cost, which means every year they are serving you, the liabilities upon you regarding that year. And then there is a past service cost. For example, if there are any changes within the employee remuneration, and as a result, there is a change in the pension, that is recorded as the past service cost. And then there are any curtailment gains or losses that should be booked within the service cost as well. So service cost is actually the prime component. The service cost is the prime component, and within the service cost, we have the current service cost. The current service cost means, as I already told you, when the employee has served you 1 year, that increases your liability to pay them the pension. Past service cost, which is related to the change in the pension plans. And then when there is a curtailment gains and losses, for example, in case of redundancies, your pension plan will be reduced and you will be actually making payments from that. So in that case, either it is going to create a gain or a loss, which should be recorded within the service cost. So these three components. And other than that, there should be the net interest. The net interest. Net interest means you're going to take the opening balance of obligation minus the opening balance of the plan asset and multiply by the interest percentage, and then you get the net interest. This net interest is part of the statement of profit or loss, the profit or loss component as well. So there are two things. The first thing is the service cost, and the second thing is the net interest. So these two things are going to be part of the profit or loss. Make sure you remember these things. Then in the other comprehensive income, as I've already told you, that you are actually dealing with the pension plan based on the actuarial assumptions. Now, the assumptions may change, and that will give rise to a remeasurement gain slash loss, which is being recorded within the other comprehensive income. That liability may change, asset may change, remeasurement gain and loss. Why it is being recorded in the OCI and not in the profit and loss? Because these are the assumptions. So when we have the assumption, these are not the actual figures. So when we have the unrealized thing, it should be recorded within the other comprehensive income. And then we have the statement of financial position thing. When your plan is in surplus, it will give rise to the plan asset. When your plan is in deficit, it will give rise to the plan obligations. But with reference to the plan asset, there is a figure, there's a concept which is known as the asset ceiling. This is something very important to understand. Asset ceiling. What is asset ceiling? So when your pension plan is in surplus, you're supposed to record the plan asset, but not the amount that is the difference between the plan asset minus plan obligation. The standard says that you are going to record the amounts which is actually recoverable, the amount which is actually recoverable. Now, when your plan is in surplus, you have two options. Either you are going to stop your contributions for a while to just to balance the plan asset and plan obligation thing, because you have no intention to earn from these pension plans. The intention is to just meet the amounts which we are supposed to pay to the employees. So you are going to stop your contribution for a while, or you are going to withdraw some funds out of the plan. So whatever you are doing, so just see whatever you are doing. If you're stopping the contribution, those contributions which are not being made should be recorded as the plan asset. If you're withdrawing something from the pension plan, that money which you are going to withdraw, it should be recorded as the plan asset, not the amount which is the difference between the plan asset and the plan obligations. So these are the things that you need to remember for the IAS 19. The main treatment is what is the difference between the defined contribution and the defined benefit.